free cash flow to the firm. The expanded definition for FCFF is that it's the free cash flow available to the firm's providers of capital. So I know everyone refers to it as free cash flow to the firm, but really the proper terminology is it's free cash flow available to the firm's providers of capital. And what that implies is that this is cash flow available for distribution to all the capital providers to the firm. That includes the debt holders, preferred shareholders, and common shareholders. Now, the term free implies that this is cash flow that's available only after the firm has made necessary reinvestments back into its operations. And you can see why this is the case, right? So if a company doesn't reinvest in its assets, you know how they have equipment that's aging. If they don't replace those equipment or machinery, then the company will cease to exist. So when you see the word free, it says this is cash that's available only after the firm has reinvested back into its assets. Now with reinvestments, it implies that the company's purchasing assets. So whenever a company says we're reinvesting back into the firm, that simply means that they're buying assets. And what we like to do is we like to break down those assets into two categories. Short-term assets such as inventory, and this is referred to as change in working capital during the year. So if a company buys more inventory during the year, they're making a working capital investment during the year. And the other thing we have to be careful about with cash flow, we just want to know what happened to the cash flow during the period. But when you're looking at balance sheet items, what we really need to do is we need to look at the change in that balance sheet item in order to see what happened during the year. And that's why for short-term assets, or I should say investments in short-term assets during the year, we don't look at total inventory, we look at change in inventory, or more broadly, change in working capital. And the other category of assets or reinvestment would be long-term, such as property, plant, and equipment, and we simply refer to these as capital expenditures. And again, ladies and gentlemen, you really have to visualize what's happening here. When the firm makes cash flow, the first thing it has to do is it has to replenish its assets. So it's got to stock up its shelves again with inventory, and then without a doubt, some of its machines are becoming obsolete, so it needs to replace those. And only after making those reinvestments can we look and see how much cash is available for distribution. So with that backstory, or with that big picture, now we can discuss the framework for calculating free cash flow to the firm. So the starting point with free cash flow is just net income. So whatever net income has been reported. But as we know, net income includes cash items and non-cash items. But the thing with free cash flow is that we're just looking at cash items. So the first thing we have to adjust net income to is any non-cash items it may have. And of course, the big one is depreciation. So let's have a look at the note here and what we have for depreciation. While depreciation expense is non-cash, it does affect tax, which is cash. So what we have to do is we first deduct depreciation in order to calculate tax and therefore net income. And then we add back depreciation because it was not a cash outflow. So I see depreciation in two places in our FCFF framework. Where do you see it? I see one here. Well, where's the other one? It's actually embedded in net income. So we needed to subtract depreciation first so that we can calculate our tax. And then, of course, after tax, we have net income. But then we add back depreciation because we never spend that depreciation during the year. And let's do an illustration. So here's an income statement. Let's start off with EBITDA. So the EBITDA or earnings is $1,000. And then we subtract depreciation. Let's assume it's $100. So therefore, earnings before tax is $900. And then assuming the tax rate is 30%, so 900 times 30% is $270. That's our tax. And then therefore, whatever remains is net income, which would be $630. So to calculate cash flow, we're going to use two approaches. One is direct, one is indirect. And the direct approach says, just give me the cash line items. So here's a cash item, so the $1,000. Now, depreciation is non-cash. EBT, that's just a subtotal. The only other cash item is $270. So EBITDA minus the tax, remember these are both cash flow items, we get total cash flow that's equal to 730. Now the indirect approach, which is what this framework uses, starts off with net income and simply adjusts it for any non-cash item. So for example, start from here, and tax is cash, right? EBT is a subtotal. So the only thing that's not cash on the income statement is right here, the depreciation expense. And since the depreciation was subtracted to calculate net income, in order to neutralize net income for depreciation, we simply add back the depreciation. So when we start with 630 and we add back that deduction, right, because it was a deduction, we get 730 again. And that's really the process we use in order to extract cash flow from net income. And as an analyst, you need to be an expert in doing that, because the company will report net income, and of course net income is based on their revenue recognition policies and expense policies. So you need to take the net income that they're reporting and say, okay, how much cash did they really make during that year? So all this to justify why we add back depreciation. And I know I could have asked you just to memorize add back depreciation, but then you wouldn't know what's happening. But now you do. Now you do. Now what are the other adjustments? Well, so if you add depreciation to net income, that gives you the generic cash flow as I demonstrated right there, right? However, now we look at the free part. So we did the cash flow part. Now let's concentrate on the F there, which stands for free, right? Well, this cash flow is not free until the company makes reinvestments back into the firm. And as we described before, reinvestments into the firm is really purchasing assets. There's a short-term assets. And again, notice it's a negative, right? Because if you're buying assets, that means you have less cash, right? So if you're buying more inventory, that means now the company has less cash available for distribution. And similar for capital expenditures. So if the company's buying new machines, that means there's less cash available for distribution. Now the last adjustment we make in order to calculate free cash flow to the firm is the interest adjustment. And let's go to our notes here. Interest adjustment. So free cash flow to the firm is cash flow available for distribution to all capital providers, and that includes debt holders. However, so I should say debt holders are entitled to interest, but net income deducted interest. So let's go there one more time. Net income, ladies and gentlemen, is the bottom line on the income statement, which means by the time you get to net income, you've already subtracted interest. But remember, free cash flow to the firm, that's cash available to shareholders and debt holders. So imagine the debt holders are having a conversation with net income, and the debt holders are telling net income, hey, why'd you subtract interest? That was our money. Why did you subtract it? So then what we have to do is we have to add back that interest. So do you see how we're neutralizing net income? So when you add back interest, it's as if net income never really subtracted interest. Now the other adjustment is net income is after tax, whereas interest is before tax. So if you are going to add back interest, it has to be on a after-tax basis. And that's what we have. To neutralize the effect, in other words, meaning to neutralize the fact that net income subtracted interest, we add back interest expense, and since net income is after tax, we add back the after-tax interest. And there it is, ladies and gentlemen. So once once we make all these adjustments to net income, so there's net income. Once you make all these adjustments to net income, we get our estimate for how much cash is available for distribution to all the capital providers. Now, note 3, free cash flow to the firm excludes cash flows resulting from capital contribution. In other words, free cash flow to the firm is the cash flow generated on the capital and not the capital itself. So for example, if capital providers invest 100 million and the firm generates 15 million on that capital, then the free cash flow during the year would be 15 million and not the 115 million. And that makes sense, right? So if let's just say we're the capital providers and we gave this firm 100 million, well, the firm can't turn around and say, hey, they just generated 100 million. No, that's the cash we gave you. Now tell us how much cash flow you generated on that capital we gave you. And that is the free cash flow.